Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
It's definitely not Phil Tarrant today. It's Katarina Taurian, and I'm the head of editorial here at Smart Property Investment. So pleased you could join me. And I'm also so pleased that I've got Anna Porter here with me today, and she is Principal and Property Advisor at Suburbanite. Welcome, Anna.
Thanks for having me.
Your firm are property investment advisors?
That would be correct.
Across Australia?
Yes.
Amazing. So you've been speaking to us here at Smart Property Investment a fair bit about new and off-the-plan developments. As myself and the team have been saying for quite a few years, there are always big opportunities with new builds, but you need to be about 100 times more careful, we think, particularly in New South Wales. Where do you stand on that issue?
I'd agree with that comment entirely. So new builds are certainly one way of buying property, but there is some risk. There's legal mechanisms you need to understand, and every buyer has to go in with a certain level of caution and due diligence in the process.
Okay. What does that process look like then?
Yeah, so there's a couple of different areas that reflect risk. So the first one, and I think probably the biggest one in my mind, is the lending risk or settlement risk. So when you go and buy an established house, it all happens in real time effectively. You get the loan, you get the pre-approval, you deal with the banks, and then the settlement happens pretty quick thereafter. So it's all done in fairly real time. When you're buying something that's off the plan or during construction, you have to go to the bank and get your pre-approval done, and they won't give you a sort of a final look in on your lending capacity until 90 days out from settlement. So think of the timeline. You find the off-the-plan property you like, you put a deposit down, which is 5 or 10%. Even if you only put down 5% because the developer allows that, you are legally required to give them 10% if you don't settle, so the balance. Then it could be a year or two before you have an end product. So over that year or two, the bank's policies could change around lending. Your personal circumstances could change, and it happens all the time. It happened recently to a friend of mine. In that 12-month period, they went and started their own business, left their PAYG job, changed houses, like all these things happened. And then they got 90 days out from settlement, and the bank said, well, because of your changing circumstances coupled with our changing lending policy, you're not eligible for this loan anymore. And that's a really common occurrence. You know, we speak to some of the powers that be in the big banks, and especially in this lending environment, there are a lot of properties not settling. So what happens then is the buyer has to make sure they've paid the developer the full 10% deposit if they haven't already paid that. Then they walk away from the property, and the developer can then also go them for all the costs they're out of pocket. So interest costs, holding costs, remarketing costs, reselling costs. And if the developer then sells it for less money than what was originally committed to with that first buyer, they can actually sue you for the differential as well. So it's a big risk to take.
Ouch.
Yeah, it can be a big ouch. And I've met a lot of people that have lost a lot of money. So it's very much something you need to really consider about how you protect yourself. So there's a couple of mechanisms you can use. In some states, you can get a finance clause all the way through to settlement, which is something I would significantly consider if you can get that.
What does that look like?
So it's really just a function of the contract. And in New South Wales, they say we don't do that. You can't do that, but you actually can. It's a negotiation. It's just not standard practice, which is going to the developer or the agent and having that your solicitor draw into the contract a clause that says that if you can't secure finance at the time of settlement, you can get out of the contract for a minimal fee. So it might be 1% or 2%, not 10%. So the developer will still want some consideration, financial consideration for that, but it doesn't necessarily need to be 10%. So that would give you a level of protection. The other way to look at doing it is if you have a good amount of assets currently, when you go into that contract, you could potentially look to draw down the funds early. So if you're buying an investment property, call it a $500,000 or $600,000 purchase, you might have enough equity in your own home or other assets to actually go to the bank and draw down the funds and sit them in an offset account, the whole amount to settle, ready for that in anticipation that even though it's 12 months away, while you actually know you can get the finance. So just create that real safety net for yourself is another way you could look at doing it as well, or potentially take the risk. But it is a big risk to take. So that's when you got to look at, do I have a plan B and a plan C? So is plan B mum and dad? Is plan C, a friend of mine that's in a position to help me out if I get stuck? Is plan D, looking at other second tier lenders, but again, their policies can change as well.
Yeah.
So it's always about having that backup plan.
Yeah. Your background is in valuation, right? Okay. So you would have seen many a property over the years, I imagine,
Yes.
that wouldn't have reached, where buyers wouldn't have secured finance on settlement. Is this a new issue for you? Given your history, is this just something you've seen all the time and now it's suddenly making the news?
Look, it's not a new issue. I started in property in 2003, so makes me sound a bit old, but anyway, would you believe I started when I was 5? I wish.
I wasn't born, so.
I feel older.
Yeah, no, that's not it.
So I've been doing it for a long time. It has always been an issue. I think it has hit the media a bit more in recent times because it is becoming a much more challenging lending environment at the moment. So some of the brokers that we talk to that have been lending for 20 and 30 years, now I don't do the lending piece, but I've worked in the banks as a contractor to them for the finance valuation side of things. So I understand the process quite intimately. This is probably the toughest lending environment some of them have ever seen, right, in 20 and 30 years. So that exacerbates it and creates probably more of it happening. So it's not a new concept. It's not unheard of, but it's happening, I think, in bigger volume. And I mean, the lending risk and the settlement risk is only one piece of the puzzle. Bouncing back to what you're saying about me having been a valuer, I've seen a lot of risk in that off the plan. So there's buying, units off the plan is one type where you go into an off the plan contract. There's also house and land packages or even just entering a building contract. So you might secure the land and then you enter a contract with a builder. Now, I've seen circumstances where people have not had any legal advice on those contracts. And to be honest, when I say I've seen circumstances like it's a rarity, it's actually quite commonplace that most people will enter a building contract for $400,000, $500,000 or $600,000 and not even have a lawyer look at it because, Jim the builder seems like a really nice guy.
Oh, that makes me unwell.
The builder's friendly. He's the friend of a friend that you met at a barbecue, right? So, let's just sign it off. It's not like a real estate agent. It doesn't seem like a real commercial transaction for a lot of people because they seem to trust their builder. I'm not saying builders aren't trustworthy, but I've seen builders go broke in the middle of a project. I've seen builders walk away when there's been disputes over who's paying whom and when and how and why. We see a lot of people get contracts for building signed off on without getting any checks done on it. Then they send it over to the bank to borrow the money against it, right? And what happens there is there's things in a contract called a progress payment schedule, which basically says at what stage of the build is the builder getting paid. So, when the slab goes down, that's about 20% of the construction cost. He's not getting 90% of his feet paid because what if he takes it and nips off overseas and never comes back? So it's a protection mechanism in the contract. But the banks have standards they pay out to. They're not paying out 90% at slab. They're paying out, call it about 20%. So what happens is the builder will sneak a bit of a incorrect or self-serving progress payment schedule into the contract. The owner signed off to that and then the bank turns around and says, no, we're not paying that. So then it leaves room for dispute and it ends up in a big nightmare and the builder refuses to continue to build. The bank won't draw down the funds. The poor client's sitting in the middle of this argument and it could have been simply avoided by getting legal advice on that contract, let alone what mechanisms you have as the landowner if the builder goes broke halfway through. That raises insurance issues. If the builder's halfway through the project and he walks away from it and you get another builder to complete it, who's got the insurance over the end warranty of the project if something goes wrong and you need to go back and lean on that warranty? So there's all sorts of these things that come up and they have effect on value. But the big one is for the property owner, it can be a real bag of risk, really. Like it's just a big bag of different risks that you have to navigate through correctly. And there are certainly ways to navigate it. But you need the legal advice. You need to have the right lending advice. You need to understand the risk you're taking on from a lending environment. You need to make sure people are reviewing these contracts before you sign a contract. You need to know what out clauses you have if things start going wrong through disputes or the builder doesn't stay viable during the build and his company closes up, things like that. And then obviously we've got our, the big one in the media at the moment is your mascot towers and that sort of thing with building defects. So that's a whole other area that you need to consider too.
Yeah, definitely. And actually, given that your firm is Australia-wide, do you feel like New South Wales is a hotspot for defects and for sort of problem new builds, or is that just being a bit skewed because I'm a Sydney girl and we're seeing sort of headlines with Sydney being in the news at the moment? What's your view?
Look, I think Sydney is probably in the headlines a bit more because it is a major hub. It's one of our biggest capital city in terms of population. So that means it does capture a lot of headlines. A lot of the news comes out of Sydney and, if we're Sydney-based, we tend to hear about it more.
Of course, yeah.
But it doesn't mean the other areas are immune from this. We've looked at some properties. There's a bit of a thing happening down in Geelong where a number of builders in the, just new house and land packages, good, reputable builders. So I'm not going to name any names. I don't want to ruin their reputation.
Go ahead, Anna.
I don't need a lawsuit this week. But they're good, reputable little home builders, project home builders. In Geelong have built a lot of houses over the last 4 or 5 years, and they've all seemed to use the one waterproofing company that was in the area. Now, that waterproofing company has done some naughty things, and all of these builders are now having all these defects claims on them for the waterproofing, which is a pretty significant thing. And, you'd think even if you're a property advisor, you're a buyer, or however you look at this, you'd think if we bought through multiple different builders or we dealt with different builders, you're offsetting your risk. But what happened was they all used the same waterproofing company. So when that waterproofer does the wrong thing, that flows through to a lot of houses in that area. Now, that one isn't in the media because it's not as significant and it hasn't had the coverage. But it's still, if you're the owner of that property and you're looking at $20,000 or $30,000 or $40,000 worth of defects to fix, that's a big issue. So, as a firm, we tend to buy established property. That's our approach because we can then get the pest and building inspector in. We can get all those checks and balances done to say, now that people have had showers and lived in the property and all this stuff's, happened, are there any problems? The challenge is with a new build, if it's not lived in, and no one's really turned the shower on for more than 30 seconds, how do you know that it's been done properly? And these things come up over time with wear and tear. So you've always got to be considerate of those risks, and working with a reputable builder that's been around for more than 5 minutes is really critical to when those things go wrong, they will want to fix it, right? So they will come back in and get that sorted because their reputation's on the line, as opposed to a fly-by-night builder. And I think that's what we tend to see a little bit more in the unit space as compared to the freestanding houses. I think there's a little bit of a perception in the marketplace that units are more risky with the building defects than houses are. And I think it really does come back to your houses are typically built by your really well-known brands that have been around forever, like your Clarendons and things like that. They've got a brand reputation to protect. So they'll always fix issues if they pop up and they try to avoid it in the first place. Or your local builder that just everybody knows him, does all the local houses, he's an independent, but he's been around for 35 years and this is 100% his living. So he has to keep his reputation intact too. Whereas your developers tend to be more companies that can set up a company called 123 Smith Street, build that development, and then they wind up that company at the end of it and move on. And some of the developers have only been entering the market since times have been really good. So they've jumped into the market when everything's going up in value. And some of them might be cutting corners a little bit. They might not be aware of what their requirements are into the future. And when that starts to happen, there's a fallout now. So what happened in New South Wales a few years ago was they changed the legislation around the builder's warranty. So when the builder's warranty regulations changed, it took away a lot of the burden or onus or responsibility, I suppose is a better word, from the developer and the builder, and meant that the owners didn't have as much protection. So as soon as they changed that legislation, we stopped and went, this is opening the door for problems. It's opening the door where developers and builders that are a little bit less reputation driven, what I call the fly-by-night ones, or the ones that have only been in industry for a short time, it opened up the opportunity for them to cut more corners. It opened up the opportunity for them to maybe not do as good a quality work because their responsibility into the future was lower. So now I think that's coming home to roost. And I think that's what we're seeing in New South Wales is they've cut a few corners, construction costs were high, so they're trying to find where they can save money. The market's starting to turn a corner, so they know they need to save money because they're going to be coming out with this development when the market's softened from when they bought it, maybe 2 or 3 years ago. So remember, this is a long process. The day they buy the site to the day it goes to the market as a completed product can be 2 or 3 or 4 years even. So they're already starting to look at in their build process, how do they save money because they already know that their end product's not going to sell as well. So where do they save money? Well, some of them cut corners. And I think that's what we're starting to see.
Definitely. And just on that cutting corners, it's just to know what the biggest train wreck is that you've seen. When I was looking to buy, I actually made a habit of bringing a pen with me wherever I went and putting it on the floor. And I can't tell you how many times it rolled. I've had places that I went to that were brand new, as in hadn't been lived in, and there was already mold. And that was just phenomenally unbelievable. It became super interesting, actually. I just found myself going to properties that I wasn't even interested in just to see what kind of condition they were in. Windows that don't close after it rains and the moisture that's in the air, that kind of thing. What have you seen recently?
I've seen a lot.
I bet you have.
So we don't, as a company, we don't tend to buy many units, but over the years just being in the property industry, I've been to some units where I've been able to fit my whole hand into a crack and it's gone all the way through the wall.
I mean, that's a hole. That's not a crack.
Yeah, I know, right? Went the whole way down the wall.
Wow, that's outrageous.
Yeah, and it was in the walk-in robe, the built-in robe. So you wouldn't have seen it if you hadn't opened up the built-in and moved the clothes back. And then there was this hole or crack, as they called it, that went all the way through and you could see daylight. And I thought, wow. I shouldn't think, wow. I thought I said some words that were far more inappropriate than that.
Oh my goodness.
That was one of the ones I've seen. I see a lot of water defects is the biggest one, so moisture defects. And they can be very expensive to fix. So I'm going to give you some tips on what to look for to avoid this. But before I do that, one that we came across, this is just something to be a little bit aware of. When you're going to buy a unit, whether it be almost new or a couple of years old or older, often the agent will give you a copy of the strata's financials and say, you don't need to get a strata report because I've got the financials here and this tells you what you need to know. There's money in the bank, you're good to go. We had one sent to us a few years ago that had $3 million sitting in the bank account, and the client sent it over to us and said, look, I'm going to go buy this. Everything's great. $3 million in the bank account, just that I'd run it by you for a final check. I said, don't you think it's odd they have $3 million in the bank?
So many dollars, yeah.
That's unusual in itself. And they went, oh, really, is it? I said, we need a full strata report, which they'd been told by the agent they didn't need because here's the financials, right? So we pulled down the full strata report and it showed a history of bad workmanship, a history of building defects, a history of water penetration issues. And the $3 million had just been paid into their account only a few months earlier out of the lawsuit they'd been in for the last 4 years with the developer. Now, $3 million wasn't even going to cover the defects. They were going to go beyond that price, but that was all they could get their hands on at that time from that situation.
Oh.
And it spoke to a history of poor workmanship. So I said to the client, you're potentially going to have so many issues into the future with this building, I wouldn't touch it.
Oh, that makes me unwell.
I know, right?
And that's the thing with water, it sticks around. It's not like a one-off thing that you fix, or it's not even like rising damp. You know, that is quite a sort of fixable and common thing. If you've got structural issues that are water-based, for life, that's an issue that you need to be dealing with.
That's true. And some of the things we tell people to look for in, say, a strata report. So here's what you do to try and avoid this. You get a strata report because it talks about not just the money in the bank, but it talks about things like you might see is someone might not put in there are building defects in this building, but you might start to see things about reported in the strata meetings, wording around mold, moisture, dampness, ventilation issues. And when you start to see that, you think, okay, maybe there's a bit of a pattern here. That's some of the stuff. Cracking as well can come up. So while it might not be a full defects report at that stage, it can start to speak to some of the pattern within the development that might be concerning. Then if there has been defects reported, that's obviously the next level that you need to be aware of. So I'd always recommend a full strata report. Get a building inspector out there. Even though it's a unit and he can't necessarily give you the whole building inspection, it still helps just to see if there's any issues that come to light for them. They can put moisture readings onto bathroom areas and wet areas and see if there is moisture starting to penetrate. They're also often aware if there's design issues, and they often know a lot of the buildings in the area if they're a local inspector and hear if there's been troubles. So they can give you some weighting to that and help you understand that. Sometimes you can even send the strata report to them, and if they put, a high moisture reading in this room together with some commentary in the strata report, they can make a sort of puzzle out of the pieces, and it actually makes a lot of sense then from time to time. So they're two of the things I do. The other thing I'd be a little bit cautious of is who is running the strata. So when you get the strata report, look at who the strata manager is and look at who's on the strata committee. You can look at the minutes from the meetings. And if someone on the strata committee is actually the original developer, or if the strata is owned or is a subsidiary company of the developer, and there's not going to name any names, there's a very well-known developer that's in and out of court a lot that does this. They own the strata company as well. Sometimes they can be there to stonewall or block you from making decisions. So, for example, in the strata meeting comes up all these people saying things like moisture, mold, water issues, and the strata or the person that's on the strata that was part of the original development company can sometimes then stonewall that and say, oh, it's fine, don't worry about it, don't worry about it, don't worry about it, and talk you out of taking action. Don't get a structural engineer's report, don't get the builders in, that's fine, we'll just patch that for you, we'll sort that out. And what they're often trying to do, not always, but often they're trying to get through that builder's warranty period so that they then don't have that liability because the statute of limitations has passed, and they downplay the problem through that period.
That's so cheeky.
Yeah, it is. And look for a trend of that. I know some big, good, reputable firms that put one of their staff as a repairs and defects person onto the strata because they genuinely want to manage through any issues, because all buildings will have some issues, and they are proactive. But you've got to look for the difference between proactive and really just stonewalling the process and trying to stop it. And it can be really hard to sometimes see the difference in the minutes in the meeting. So a phone call to the strata can often be quite valuable as well, just to get a feel for that.
Yeah, I bet.
You'll find out pretty quickly whether people are being blocked from decisions that they need to make or whether they're actually just being really proactive in it.
Gosh, I don't want to get too technical, but it makes me pretty mad that there's an environment, a regulatory environment where this is allowed to happen. Because if it's rife and if you're saying that this is the kind of thing that you've seen throughout your entire career, and it might just be there's sort of peaks and lows, I mean, there's a government that's supposed to be responsible for that.
There is. And
if it's not one-offs.
They have laxed the legislation, though, because it was becoming very costly for them to be involved in it. So to give it a little bit of context and to talk about the other side of it, When you're in a strata, people lose their minds over special levies, right? So you might get a 4 or 5 or 6.
I'm on a strata committee. I'm acutely aware of people losing their minds.
So something will pop up, the roof needs fixing, or this will happen or that'll happen. You've got some concrete cancer in the balconies if it's older, whatever it might be.
Literally anything.
Yes.
Yeah.
And everyone gets told there's an $8,000 special levy that has to be raised to fix this problem, and everyone goes absolutely bonkers over it and says, I've got all these problems and the developer's a scumbag and blah, 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 blah. Now, let's be fair to the developer. In some instances, every building's going to have some issues. You know, like you can buy a house that's an established house in the suburbs and a tree root grows straight through your sewer line at the front, which you have no control over, and you've got an $8,000 fix there straight up. You know, that's just part of property ownership.
Yeah.
If you're not prepared to have some costs, live in a tent. Like it's just that simple. There's always going to be some form of costs with owning property. So you've got to have a little bit of perspective and context on that if you do have a $5,000 to $10,000 bill once every year or two that everyone has to put in for, well, that's just ownership of property. You've got to be prepared for that. You've got to have a kitty for that.
Yeah.
If you don't want those things, renting is your option. Renting is where that's not your responsibility, right? That's the owner's responsibility. So that realistically might be how you have to approach it if you're not comfortable with those things.
Yeah.
Obviously, your major structural defects and poor workmanship is different. But people do start to join the conversation and start saying how bad their property is managed or how bad their original builder was when they have a few costs come up, when that's not necessarily fair either.
Yeah. Oh, look, you're absolutely right as well. You should just live in a tent if you're going to have issues with that. And I mean, I rent Vest, so the property that I'm currently living in now, I'm renting. We've just had a pipe explode. I mean, what are you going to do? That's what happens.
It is. It's a physical building, you know, and people often talk to me about shares versus property, and I'm not a financial planner. I can't tell them which is the best. I do the property strategy. Someone else does the shares conversation. But one of the big differentials is, in my experience, is shares are much lower engagement. You know, there's some clients that come to us that just struggle with the idea of having to do any maintenance on a property over time. And it's like, well, if that's how you feel and it's just an investment, there are other vehicles to invest in where you don't have that level of engagement. It's a physical thing. You can see it, you can touch it. But if you can see it and you can touch it, stuff goes wrong.
Yeah.
That's just life.
Definitely. And also there are management fees with shares and stuff as well.
That's true.
So, all right. What else have you got for us, Anna? I'll have to wrap us up soon. I think I could go on all day about properties in New South Wales. Any parting words of advice?
Look, I think my biggest advice would be to put a really good team around you if you're buying, and off the plan is something that people need to consider as, if it's an investment thing, it's not a strategy in itself. So we see so many investors get caught up in off the plan being the actual strategy. It's just a type of buying, you know, off the plan versus established. They're different ways to buy property, but at the end of the day, it's not the strategy itself. The strategy itself needs to really be focused around where is the right investment for my needs, how's it going to perform for me, how's it going to achieve my goals is the biggest one. And then from there, you reverse engineer that and you get a bit of tax deduction from off the plan. But if you end up with all these problems because you haven't done your due diligence, I can promise you it's going to wipe out any tax deduction.
Yeah.
So the tax deduction's the icing on the cake, but you've got to get all the other stuff right first. You absolutely have to do the due diligence. You have to have the right people around you. And if you haven't bought off the plan, the first thing you should be doing is getting yourself a very good property lawyer to walk you through that exercise.
Yeah.
Because they'll know all the due diligence steps. And it's a really critical part of it because when it goes wrong, it can go wrong to the tune of hundreds of thousands of dollars.
Yeah.
If it goes right, you can certainly make some money, but
Yeah.
you've got to take those steps.
Yeah, definitely. Lawyers aren't even that expensive, to be honest. I was pretty satisfied with the bill that I paid. I mean, I wasn't thrilled to be parting with money and probably went a little bit overboard in terms of who I used. It was a bit unnecessary. But, you know, when you are risking hundreds of thousands of dollars and it's your biggest investment,
It is.
a few thousand up front, I feel like if you can't afford a few thousand up front, you should probably be considering, am I the right candidate to be buying a $500,000 asset?
Completely agree.
Yeah.
Completely agree.
Definitely. Thank you so much for your time today, Anna. It was great to speak to you.
You're welcome.
Thanks for tuning in today, everyone. If you'd like to follow us on the socials, you can grab us on Twitter, LinkedIn and Facebook. You can also email us at editor@smartpropertyinvestment.com.au. And don't forget, if you like what you heard today, please leave us a rating. Thanks, and we'll catch you next time.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.